Welcome back everybody to my YouTube channel. I hope you're enjoying the content, and as I always say, if you are, drop us a like, subscribe and turn on notifications. So this is a huge mistake I noticed from a lot of price action traders. Now they come into Forex and they read a book or two, they watch a few YouTube videos and then they get to work. Now, their exposure to candlestick patterns is probably so overexposed that they end up believing that that's all they need into becoming a profitable trader. Then that leads to them trying to memorize as many possible patterns, and then they take that knowledge into the markets, place a few support and resistance lines, and then trade. Now, unfortunately, you will find as time goes on, it doesn't work like that. Now, I always say that yes, in life, knowledge is definitely power, but too much knowledge in Forex is poison. So, focusing on candlestick patterns alone is not going to help you. In order to become a consistent and profitable trader, you need the backing of confluence. Using candlesticks alone is a recipe for disaster. So what exactly is confluence? In its simplest form, it's tying everything together, making sure that you have a solid approach to increase the odds of you becoming a profitable trader. So in this video, I will show you 3 examples of how you can do this. Let's move on to the chart. Okay, so we're over at Euro CAD. Now, I don't want you to focus on the actual currency pair we're trading. I just want you to notice that we're on the weekly time frame. So what I'm about to show you now is going to be more for those that are swing traders. Okay, I'm not here to teach you a strategy. I'm just here to identify confluence as a potential swing trader. So on the weekly time frame, as a swing trader, what we're going to be looking for is major levels in the market where price is reacting to the most. So let's drop them in. So let's pop our first one here in and around this level. Now what we're identifying is wicks, 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 wicks. Okay. Again, we'll drop one here. We'll take into account as much of this information as we can, and we have wicks, 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 wicks. Let's see if we could find a finer one. And we have one down here. These are our levels. Now, as you notice, we don't need too many. We have our levels. Now, before we move on to anything else, let's identify what's happening on this market. We can clearly see the structure of this market is down. That's a no-brainer. Next thing, we can see that price is making structural highs, lower highs, lower highs. That technically should mean that when we look at the structure in the morning or in the afternoon or at the end of the day, we should be saying to ourselves, based on this structure, at this moment in time, I am looking for sells. Let's remove those last 3 lines and let's move down to the daily time frame. Now, once we move down to the daily time frame, you can see this much more clearer. Okay, so when we scroll back, what we can see here is the levels that we've drawn in where price is reacting to the most. Okay. Our support line here, we see price reacting to the most. And then finally, our target level, which is this major low here, is where price has come to now. Now, again, I'm not focusing on trying to teach you how to trade. I just want you to identify confluence with the higher time frames and stepping down to your entry time frames. Now, the rule of thumb, if you want the honest truth, is 1 time frame for your major key levels, Second time frame, which should be one lower for your behavioral patterns, and then your final one, which is going to be used for your entries. 3 time frames only is all you need. Okay, so let's remove this line. So what do we notice here? Well, let's look at this price action. These are our key levels. Now remember, these key levels came after price action has moved. So what I want you to focus on is how we potentially would have looked at this. We have on the weekly time frame structure moving to the downside, meaning we're taking sells only. We're now looking at this time frame and we're identifying a major key level in the market where price is reacting to now. Now I want to make this point. Just because price comes back to these levels, it does not mean that we're immediately looking to sell the market. Now, this is a behavioral time frame, which certainly means that all we're doing is looking to see how price is reacting in and around those levels. Okay, what we're noticing now is we have lots of wicks forming, which in itself is a confluence. So not only do we have a bearish structure, we now have wicks forming at a key level in the market. But what we need to look for is an entry. Now, the only way we're going to get an entry is if we see the behavior of this market on our entry time frame moving in a direction or the overall direction of where the market is going, which is down. So let's mark this level here. We have here evidence in the market what price is reacting to. Let's see if we can collect enough evidence along with the two confluences we have to look for a potential entry. Now, moving from the weekly to daily, remember we said we only need 3 time frames. So let's move on to the 4-hourly time frame. When we scroll this chart back, what I want you to identify here is the circle that we put was from the daily time frame. This was used to identify a key level in the market where price was reacting to. Now remember, whatever behavior happens on this time frame, it doesn't mean that this structure is broken. The only time structure is broken is always on your key time frame, which is the weekly time frame. Now what we notice is price is broken, structure broke back into structure. We have a reaction level in and around here from the daily time frame. 4 hour, which is our third time frame, is our entry time frame, means we're looking for our entries. Now what we're looking for when we go down to this time frame is not how price reacts now, but how price comes away from this level and comes back and then reacts. This gives you a third confluence. First confluence, as you can see here, we have our bearish structure. Secondly, as you see here, we have our major key level. Thirdly, we have a level in the market where price is reacting to. And then finally, we have price leaving structure and coming back. Now, does this mean we're looking to enter as soon as price comes back to this level? Well, again, no. What we need to start seeing forming is reaction from this level. That could be wicks, that could be bearish candles, that could be pin bars, dojis. I really don't care. I'm not here to teach you entries. But notice, once we have enough confluence, we can now look to take the trade, whether that's using this pin bar, whether that's using this bearish candle, whether you're looking for the breakout, whether you're waiting for a pullback, for a sell limit, a sell stop. I don't care. The point is you have entries. Now, we've built enough evidence to know that even if we're not the first in this trade, we know how structure works, and you can look to sell these structures here, these structures here. If you got caught out here, that's fine. Remember, you're using risk management. So you wait for a re-entry. If you don't take any of these trades, you can look to trade here, you can look to trade here, and you continue doing that until price gets to a major level or the market decides to reverse in the opposite direction. And as you can see, our major key level that we found on the weekly, price is tapped into almost bang on and then left the market. It has continued down up till now, but the point is it made it to that level. Now this range is absolutely huge because this is a swing trade, and the potential on this trade, as you can see, is almost 380 pips. What it is, +1. So that's how I would look for confluence as a swing trader using the weekly, daily, and 4-hour time frame. We'll just recap this. The recap is identify your key levels. See where price is reacting to the most. Then you want to be looking for the directional bias of the market. Once you find the directional bias of the market, you then want to go down to your next time frame, which is your behavioral time frame, and you want to start building confluence on how price is reacting at these major levels. Does not mean you're ready to enter yet, it just means you're monitoring the behavior. Once price signifies a continuation after a potential pullback or reaction from a major level, you can then move down to your lower time frames, your lowest time frame should I say, which is going to be your entry time frame. As we can see, we have another confluence of the wicks, we have a next confluence of price leaving the level, coming back, and then we're looking for our entries in any which way we trade. That's confluence as a swing trader. So let's move on to intraday trading. Now, what is intraday trading? In its shortest form, it's literally trying to get into trades within a period of 24 hours, in and out. We're not looking to hold them overnight, and we're not really planning to hold them over the weekend, if at all ever. So what we do as an intraday trader is we look to get into the market to take advantage more of momentum more than the swing. So when looking at this chart, what we're going to identify again is how price is reacting. On our previous example, we saw that the market structure was clearly going down. With this illustration here, what we can clearly see on this market structure is that the price is moving sideways. For that reason, what we have to do is mark our major highs and our major lows of this market structure, and now we get a true directional bias. It's ranging. Now, what's the criteria for trading ranges? Everybody's is different, but mine is to make sure that price comes to the major highs if I'm looking to sell, or come to the major lows before I'm looking to buy. So that being said, we have our key levels using the 4-hour time frame. And what we'll do is we'll move over to our behavioral time frame, which is the 1-hour chart. Now, once we're at the 1-hour chart, things become a lot clearer. Now, I want to say that a lot of you, and for those that are skeptics, will say, well, you know what, Rocks, this has happened, it's easy to say. Well, no, it happens every single day, every single week, and every single month. So if the patterns repeat, then guess what? We just have to forecast that that's what potentially could happen, and we take the trade. Okay? So again, it boils down to evidence, and once we start to see price giving us the evidence that it's reacting from major levels, what we then have to do, and even to the downside, what we then have to do is we have to wait for price to come back to these levels. Okay, so the confluence here is that price is giving us a true directional bias, which is sideways, and we're getting the rejections that we need in order to identify bearish pressure or if we're looking at it from the bottom, bullish pressure. Now, does that mean we're taking a sell immediately? Well, no, this is our behavioral time frame. What we'll do, we'll take a look at some of these levels here and these levels here so that we can identify a sell opportunity when the time is right. The confluence is the market's moving sideways, but we're getting the evidence that it's reacting to major levels. And when selling a range, what we're looking for is for price to come to the major highs, or when buying a range, looking for price to come to the major lows. Let's move on to our entry time frame, which could be around the 30-minute or 50-minute time frame. So now we have price coming back to these levels here, and just like I gave you an example on the previous time frame, once we get a reaction from the market structure, I wouldn't rush to sell now. What we have to allow price to do is leave that area for a period of time, come back to the area, and then look for our evidence. So with this, we have three confluences. The market's moving sideways, clearly identifying to us it's reacting at a